All right, I've got three stocks that are trading below their intrinsic value right now. They each have their own unique strengths and weaknesses, and we'll break down their intrinsic value using two powerful valuation methods, Benjamin Graham's formula and the discounted cash flow model. So whether you're a dividend seeker, a value hunter, or a growth chaser, this video has something for you. Before we jump into the stocks, let's quickly define intrinsic value. It's basically the real worth of a stock based on its financials and growth potential. Unlike the market price, which can swing widely, intrinsic value focuses on the fundamentals of a company. So looking at the two methods we're going to use, Benjamin Graham's formula, we're basically going to take the earnings per share, the expected 7 to 10 year growth rate, the cost of AAA corporate bonds, as well as the PE of a no-growth stock. I won't really get into the formulas in this video, but I'll be posting a more in-depth explanation of intrinsic value calculations next week. And for our discounted cash flow model, we'll be taking free cash flow, which is the cash generated by the company. We'll take the growth rate, which is the expected free cash flow growth, and we'll put a discount rate on it, which is our desired rate of return. First up, we've got Comcast. It's a telecommunications giant with some pretty strong free cash flows and a history of solid dividends. And Comcast is currently trading at $38.80 per share, but what's its intrinsic value? So using Graham's formula, we'll take the earnings per share of $3.66, we'll expect a growth rate of 5%, and the current yield with AAA corporate bonds is 5.14%. So putting that into the calculation, we come out to $66.21 as the intrinsic value, which is an undervaluation of 41%. Now let's check the DCF model. So for the DCF, using a free cash flow of $16.12 billion, a 5% growth rate, we calculate an intrinsic DCF value of $60.95. So with that intrinsic value, we can see that on the DCF model, we're about 36% below its fair values. So as far as its strengths, it's got a stable cash flow, it's pretty dominant in broadband, and it's got a solid dividend. But its weaknesses are cord-cutting risks and regulatory challenges moving forward. Next up is Elevance Health, which is basically a leader in healthcare services, benefiting from a rising demand for medical care. It's currently trading at $366.30, so let's run those numbers. Using Benjamin Graham's formula, we take the earnings per share of $29.45, a growth rate of 4%, and the same AAA bond yield. This basically brings us to an intrinsic value of $475.13 per share, showing a 23% discount. For the DCF model, using free cash flow of $8.5 billion and a 4% annual growth rate, we're able to calculate the price of $440.75, which represents a 20% undervaluation under that. A couple of strengths for this company are its consistent healthcare demand, its strong cash flows, and its exposure to the aging population. Its weaknesses, though, are regulatory uncertainties and potential margin pressures in the future. Hey, are you lacking spreadsheets in your life? Make sure to join my Patreon as a free member. You'll get access to spreadsheets like the one that I use for stock picks, as well as a budgeting spreadsheet, and I'll probably have more to come. The link is in the description through the Linktree link. Let's get back to the video. Next, we have Intel. This is a pretty big semiconductor giant that's been undergoing major transformation over the past several years. It's trading at $20.30 per share, but let's see if it's undervalued. For Benjamin Graham's formula, we use the earnings per share of $1.84, a growth rate of 3% per year, the same bond yield, and our result comes out to $26.09 per share, which is showing a 22% discount. And since the company's current cash flow is negative, we'll use a conservative DCF approach. We'll factor in a negative cash flow recovery with a 3% growth rate. So with that calculation, we basically come out to $24.50 per share. For its strengths, it's pretty dominant in the semiconductor industry, and it's had some pretty heavy R&D investments over the past several years. For its weaknesses, they've had some execution issues, and they're also getting some competition from AMD and Nvidia. So to categorize all these companies, Comcast is the stability and dividend play, Elevance Health is the undervalued and healthcare defensive play, and Intel is a calculated growth risk play. All three of these are pretty undervalued based on Benjamin Graham's formula in the DCF model, but remember, always be sure to research before investing yourself. Anyways, if you guys enjoyed the breakdown, make sure you like the video, subscribe to the channel, and leave in the comments what you think about these three stocks. Also, if you haven't already, join the free Patreon. I've got those spreadsheets up there. There's going to be more to come, so it's completely free. Just hit join us free member. Anyways, I appreciate you guys for watching, and I'll see you in the next one.